Ian, thank you so much for joining me here at SuperReturn International. Phenomenal event with so many of your industry here. You're having lots of meetings, key conversations. What do you think are the key challenges that those people are talking to you about at the moment? What are the main concerns that the industry leaders have?
We have a big data science business that studies private markets, and the themes that are coming out of that part of our business are themes that rhyme with an industry that is maturing. How that manifests itself for LPs and GPs, it looks like a slowdown in fundraising and a slowdown in distributions and consolidation of managers. All of the conversations that are happening today are coming from whatever perspective. If you're an LP, you're a customer and a client in this industry. If you're a GP, you are a provider of asset management services. And so your lens is shaped by your position in the asset class. But everyone is talking about the same themes: valuation challenges, a slowdown, fundraising challenges, distribution challenges, and they're trying to find the opportunities and the silver lining to talk about. But that's the dominant set of themes at the conference that I've been exposed to today.
What you're describing there is what I think you've talked about quite a bit, which is that the industry is maturing, and that happens to be coinciding with a challenging market for geopolitical or economic reasons. And the two things are happening at a similar time. And perhaps this industry needs to acknowledge that they are maturing and the growth is going to slow.
I think those are two really different things. For the last 20 years, the private market industry has been going through its growth and adoption phase, which in any industry is this very steep growth curve. That growth curve, in part, was allowed to happen because you had this abnormally, just very strange 3 decades of geopolitical risk coming down to almost nothing, the cost of capital coming down to almost nothing. And so this industry went through its growth phase during a period where there really wasn't a lot of risk that needed to be priced. Now, you're in a normal environment where geopolitical risk is real, the cost of capital is normal, it's not cheap, and competition is fierce because the industry is now maturing and it's going through the maturation phase of its evolution, and not all of the animals in this ecosystem are prepared for that evolutionary phase.
Because growth has been abnormal in that sense, and we're not going to potentially see those sort of numbers, and that's normal actually.
That's absolutely normal. Every industry eventually goes from its growth phase to its maturation phase. And it's not that the industry isn't going to continue to grow. It's just that instead of growing at 15 to 20% per year for decades, it's going to grow at 8 to 12%. And so if your firm wants or needs to grow at that 15 to 20% rate, for the first time in this industry's history, you're going to have to take share from other firms. And that competitive dynamic hasn't really existed systemically within private markets. It does today, and it's not going to go away.
And what do you think is going to be key for those that do want to grow? What do they need to look to be doing?
That's simple. You have to generate alpha. The only reason an investor should lock their capital up in this illiquid structure is if they have confidence they're going to be rewarded for that illiquidity. How much illiquidity is very different investor to investor and product to product. If you are a manager that has a unique ability to originate alpha consistently and durably, there are customers that need that, and you will find each other and you can grow your firm. If you do not generate alpha consistently and durably in a repeatable way, you do not have a right to manage illiquid capital, and your firm will become obsolete. But that's just the consequences of a maturing market.
And what levers will those companies have to pull to be able to generate that alpha that you've described? What do they need to be doing? What teams do they need to have? What expertise do they need?
It's a great question. When we help firms break down their sources of alpha, there's 6 areas that they can create it in our framework. We call them organizational competitive advantages, OCAs. Some of them are really simple: sourcing, your investment process, your value creation process, how you exit businesses. Those are ways to source investment alpha, but there are also ways to generate organizational alpha, fundraising and client service, firm strategy and operations. Those are the sources of investment and organizational alpha. Firms go through their own evolutionary curve. Very early on in a firm's evolution, all of those OCAs are people. There are people that are good originators, people that are good investors, people that are good fundraisers. As firms evolve and scale and try to compete in bigger and bigger pools, the level of skill that they need is higher. And the firm has to transition from those being people-based skills to firm-based skills. And that's where technology and infrastructure and brand show up. Those things are really non-existent when it's just a bunch of deal junkies that founded a firm 18 months ago. But for what we call tier 1, the biggest firms in the world, level 9, level 10 firms, those are firm level processes and advantages that they've built over decades.
And do you think there'll be a synergy there from what you've described between a balance between human talent and the use of tech? Because obviously there's been so much conversation around how AI is going to be integrated into businesses and as an investment opportunity, but within the investment companies themselves. From what you've described there, there's a marrying that the human factor is still required, but it's got to play along with new, efficient ways of working.
What you just said is exactly right. The technology will unlock efficiency, and it will unlock effectiveness of really talented people. And so when people talk about deploying technology, AI, machine learning within their firms, my guess is 90% of them have no idea what they're talking about yet. They just know they have to talk about it. Technology is a way to take people level skill and convert it into a firm level asset. And AI and machine learning are part of that. But you need great people who have skill that the machinery can learn from and amplify, if that makes sense.
Absolutely makes sense. And from what you were saying earlier about this sort of more complex and competitive environment that private capital is turning into and becoming, the heart of that will be leadership.
Yeah, it requires a different kind of leadership, but it also requires a different set of capabilities. If you want to grow as an organization over the next decade, if you aren't already investing heavily in your client service and fundraising and technology and finance and balance sheet and the equity of your firm, you better start soon, because the J curve for the payoff on those investments is long, but the technology investment can shorten that J curve's payoff, and it can make the upside of those investments significant. Getting that right requires leadership to understand what is your firm really good at. What is the thing that you do uniquely well that is defendable with great people and great technology? And then make sure that you are rewarding, incentivizing, and aligning those great people, arming and enabling them with great tech so that they can take share from the people that aren't doing that.
You know, what you're describing is a sort of kind of exciting environment ahead, just finally. And if I was to be sitting here with you in a year's time, what do you think we'll be talking about then, and what are you going to be focusing on over the next 12 months?
This industry actually moves and adjusts pretty slow. My guess is in a year, most of this room is talking about most of the same things. If they're not, it's because something phenomenal that nobody here sees has happened, or something really bad that nobody here has predicted happens. If you have one of those tail opportunities or risks, people will be talking about that thing. If one of those things doesn't happen, the themes that are driving the narrative today are going to be issues and themes that drive this market for the next 5 years. Assets are overvalued. Fundraising is hard. Investors are questioning private equity's role in their portfolio. Those things are going to persist as we go through this evolutionary phase. And when we get to the other side of it, the firms that are thriving will look different, and they'll be serving customers better, more efficiently and more effectively, and that's pretty exciting.
Well, Ian, I look forward to sitting down with you again in the future
I would love
to see
to do
whether
that.
your predictions come true.
I appreciate the opportunity
Great to see
to
you.
spend time with you.
Thanks
Thank
for
you.
sharing your time with us.
Take care.